Hey everyone, welcome to today's video. Whether you've been curious about investing in the stock market or you've been sitting on the sidelines, wondering where to start, today is your day. We're diving into the stock market basics, breaking down how it works, why people invest, and how you can start building your wealth. Investing in the stock market might seem intimidating, but it doesn't have to be. By the end of this video, you'll have a clear understanding of how the stock market works, the different types of investments you can make, and how you can get started on your investing journey today. So if you've ever thought about making your money work for you, or if you just want to get ahead financially, this video is exactly what you need. Let's get started. What is the stock market? First off, let's break down what the stock market is. You've probably heard the term before, but do you really understand what it means? The stock market is a place where buyers and sellers come together to trade ownership in public companies. When you buy a stock, you own a small piece of that company, and as the company grows, your investment has the potential to grow as well. For example, if you buy shares of a company like Apple or Tesla, you're essentially purchasing a small stake in that company. As those companies make profits, the value of your shares might increase, and you may even receive dividends or payments from the company based on its profits. But what does that really mean? Well, companies raise money by selling shares to investors like you, and in return, you get the chance to benefit from the company's growth, either through stock price increases or dividends. Segment 2. Stock exchanges and how they work. 5 minutes. Host. Now, let's talk about where the stock market happens. The stock market doesn't take place in one single location. It's spread across a few major stock exchanges. The two biggest in the US are the New York Stock Exchange, NYSE, and Nasdaq. The NYSE is one of the oldest and largest stock exchanges, and it's where stocks of some of the biggest companies in the world, like Coca-Cola and Walmart, are traded. Nasdaq is an entirely digital exchange where companies like Amazon, Microsoft, and Facebook are listed. Unlike the NYSE, there are no physical trading floors at Nasdaq. Everything is done electronically. So, think of a stock exchange like a huge marketplace, where buyers and sellers meet to make deals. But instead of buying fruits or clothes, you're buying shares of companies. Types of stocks and investment vehicles. Now, let's dive into the types of stocks and other investment vehicles you can buy. You might have heard of terms like growth stocks, value stocks, and dividends, but what do these really mean? Growth stocks. Growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies. These companies typically reinvest their profits into expanding their business, so they don't usually pay out dividends. Instead, their stock price increases over time, allowing investors to sell for a profit. For example, Tesla has been a growth stock. Its stock price has grown dramatically over the years because the company is innovating and disrupting the automotive industry. Value stocks. Value stocks are shares in companies that are undervalued compared to their intrinsic value. These companies are usually more stable and established, and their stock price may not rise as rapidly as growth stocks, but they are often less risky, making them ideal for long-term investors. Companies like Johnson & Johnson and Coca-Cola are examples of value stocks. They're solid, reliable companies that have been around for decades. Dividend stocks. Dividend stocks are shares of companies that pay regular dividends to their shareholders. This is a great option if you're looking for a source of income from your investments. Think of Procter & Gamble, McDonald's, or PepsiCo. These companies pay out dividends on a regular basis, and if you own shares in them, you'll receive a portion of their profits. Exchange-traded funds, ETFs. ETFs are a basket of different stocks that track an index like the S&P 500. Instead of picking individual stocks, you're investing in an entire market sector. This offers diversification and helps lower risk. ETFs are a great option for beginners because they allow you to invest in a variety of stocks with one purchase. The importance of diversification. Speaking of diversification, let's dive deeper into why it's so important. Diversification is one of the fundamental principles of investing. It means spreading your investments across different sectors, asset classes, or regions to reduce risk. The goal is to avoid putting all your money into one single investment or market. Let's say you invest all your money into a single stock. If that stock crashes, you could lose everything. But if you diversify and invest in a range of stocks, bonds, ETFs, and maybe even real estate, if one investment drops in value, the others may hold steady or even increase. ETFs are a great way to diversify quickly. By purchasing an ETF that tracks the S&P 500, For example, you're instantly investing in the top 500 US companies. If one company underperforms, the others in the ETF may compensate for it, balancing out your risk. How stock prices move. Let's talk about how stock prices actually move. Stock prices fluctuate based on a few key factors. Supply and demand, company performance, and market sentiment. Supply and demand. Stock prices move up and down based on the demand for the stock. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. Company performance. A company's performance is one of the biggest factors in determining its stock price. If a company is doing well, making a lot of money, and growing, its stock price will likely go up. If a company is struggling, the stock price will probably fall. Market sentiment. Investor sentiment can also have a big impact on stock prices. If investors feel optimistic about the market or a particular company, they'll buy more shares, pushing the stock price up. If they're feeling fearful or uncertain, they might sell, causing the price to drop. Risk and reward. Investing in the stock market is always a balancing act between risk and reward. Risk refers to the possibility that your investment may lose value, while reward refers to the potential for your investment to grow over time. Generally, the higher the risk, the higher the potential reward, and vice versa. For example, investing in growth stocks or startups may carry high risk, but it also comes with the potential for large returns. On the other hand, value stocks or dividend-paying stocks tend to be more stable and safer but may offer lower returns in the short term. As an investor, your goal is to find a balance that matches your risk tolerance or the level of risk you're comfortable with. If you're just starting out and have a long time horizon, you might want to take on a little more risk with growth stocks. If you're closer to retirement, you might want to lean towards more conservative investments. How to start investing. Now that you have a solid understanding of how the stock market works and the different types of stocks you can invest in, let's talk about how to start investing. Choose a brokerage. To invest in the stock market, you'll need to open a brokerage account. Some popular platforms include Robinhood, Fidelity, Charles Schwab, and TD Ameritrade. These platforms allow you to buy and sell stocks with ease. Deposit funds. Once you've chosen your brokerage, the next step is to deposit funds. Most brokers allow you to transfer money from your bank account directly into your brokerage account. Don't feel like you need a huge amount of money to start. Many brokers allow you to start with as little as $100 or even less. Start small and diversify. If you're new to investing, start small. Consider investing in an ETF or a mutual fund for diversification. This will allow you to spread your investments across many different stocks, reducing your risk. Call to action and conclusion. Alright, now that you have a solid foundation, it's time to start your investing journey. Whether you're looking to grow your wealth, plan for retirement, or generate income, the stock market can help you achieve your financial goals. Remember, investing is a long-term game. Start small, stay patient, and stay consistent. And most importantly, don't forget to keep learning. The more you understand, the better your investment decisions will be. If you found this video helpful, don't forget to like, share, and subscribe, and leave a comment below if you have any questions about investing or the stock market. I'll be happy to help. Thanks for watching, and I'll see you in the next video.